Hi everyone, I hope you're all doing wonderful today. I am the Portfolio Panda, and my job is to try and create transparency in the financial world. Today we are going to discuss what is an ETF. Not to be mistaken with DTF, exchange traded funds or ETFs are a low cost way to earn a return similar to an index or a commodity. They can also help to diversify your investments. You can buy and sell units and ETFs through a stockbroker, the same way you buy and sell shares. An ETF is a managed fund that you can buy or sell on an exchange. When you invest in an ETF, you don't own the underlying investments. You own units in the ETF and the ETF provider owns the shares or assets. This means that you have no voting rights to the company, so if you want to have a say in the company's future, ETFs may not be for you. ETF units can be created or redeemed to match investor demand. This helps the price of the units to stay close to the net asset value or NAV of the ETF. This differs from shares in a company or units in a listed investment trust, where the price fluctuates based on investor demand. Types of ETFs. Passively managed ETFs. In Australia, most ETFs are passive investments that don't try to outperform the market. The role of the fund manager of a passive investment is to track the value of an index, for example the ASX 200 or S&P 500 or a specific commodity, such as gold. The value of the ETF goes up or down with the index or asset they're tracking. For index funds in particular, if a very large company suffers a serious loss, then it will in turn affect the ETF. For example, Apple has a current index weighting of 7.13% for the S&P 500, meaning that in an index fund it would take up 7.13% of the fund. If Apple abandons tech products and starts making gas station burritos instead and their share price plummets, this will have an effect on the fund. Thankfully, a lot of index funds do regular rebalances, which can help to prevent such things. But it's something to consider. Active ETFs and hedge funds. Exchange-traded managed funds, also known as active ETFs, and exchange-traded hedge funds are actively managed investments. For these funds, investment managers may use high-risk trading strategies to try to outperform an index. Physically backed and synthetic ETFs. ETFs can be either physically backed or synthetic. Physically backed ETF invests in all the securities in the index or a sample of the securities in the index. Synthetic ETF holds some of the underlying assets and use derivatives to copy the movements of an index or asset. This type of ETF may use the word synthetic in its name. Synthetic ETFs have an additional risk that the counterparties of the derivative could fail. If this sounds confusing, don't worry. It definitely isn't. It's something we can look at further in the future, but for now, a brief overview is okay. What you can invest in through an ETF. ETFs are available for a range of asset types and individual assets. These include Australian shares, international shares, sectors of the Australian or international share market, such as mining or financials, fixed income investments like bonds, precious metals and commodities, foreign currencies, crypto assets, and basically any mix of the above you could think of. Pros and cons of investing in ETFs. Weigh up the pros and cons before you invest in ETFs. Pros. Diversification. ETFs allow you to buy a basket of shares or assets in a single trade. This can help to diversify within an asset type. ETFs also allow you to invest in markets or assets that can be difficult or expensive to access. You can also diversify across ETFs, so there's less chance of loss if an ETF provider collapses. Transparency. ETFs publish the net asset value daily. This can help you track how the underlying assets are performing and if the price of the ETF is close to the NAV. Most ETFs publish the list of assets owned by the fund, so you know exactly what the ETF is invested in. Low cost. A lot of ETFs have a low management expense ratio or MER. They're usually cheaper than equivalent managed funds. Easy to trade. You can buy and sell ETFs during the trading hours of the exchange through a broker. You can typically buy smaller quantities of ETF units that are unlisted managed funds. Cons. Market or sector risk, currency risk, liquidity risk. If you want a little more detail on what these risks include, check out my How to Invest video, where I cover these a bit more. Tracking errors. An ETF's return may differ from the index or asset it's designed to track. This can be due to differences in the assets owned by the ETF and the index it is designed to track. Fees, taxes and other factors. How to buy and sell units in ETFs. You can buy and sell units in an ETF through a stockbroker. It's the same as buying and selling shares. You buy and sell at the market price at the time of the trade. Settlement of trades takes place 2 business days after you buy or sell the ETF. You have to pay brokerage fees when you buy or sell an ETF. You may also be able to buy and sell units in the ETF fund directly with the ETF provider. These transactions will occur at the end of the day with the price reflecting the NAV of the units. Compare the price and NAV. You can check if an ETF is fairly priced by comparing its price with the NAV. To explain a little further, let's pretend the fund is worth $1 and it holds 2 shares, both worth 50 cents. The NAV is calculated by taking the assets of the fund, subtracting the liabilities and dividing this by the number of units in the fund at the end of the day. So in theory, if the shares in the fund both go to $1, then the NAV is $2 and the cost of the fund is $1 that is trading at a big discount. It could be a very attractive option. There are however reasons as to why it might be trading at a discount though, so if something seems too good to be true, it probably is. ETF providers give updates of the NAV on the exchange at the end of the day and generally on the ETF provider's website. The price to buy and sell an ETF should be close to or below the NAV per unit, but at times, such as on days with large changes in prices of the asset types, the price of the ETF may move away from the NAV. You can use the NAV as a reference point during the day to understand if an ETF you're buying or selling is at or close to the NAV per unit. When to buy and sell ETF units. To get an ETF price that is more likely to represent its underlying value, check at least 30 minutes after the market opens. In addition, it's best to buy and sell ETFs when the underlying asset is open. If you're buying or selling an ETF tracking Asian shares, check the price when Asian share markets are open. Check the product disclosure statement before you invest. The product disclosure statement contains a lot of information about an ETF. In it, you will find information about what index, sector, or asset the ETF seeks to replicate, fees and costs, how to buy or sell units in the ETF on market or, if allowed, directly with the ETF provider, the risks of investing in the ETF, how to complain if you have a problem with the ETF. As usual, let me know any questions in the comments below and make sure to share this with your least financially savvy friend, then tell me if I did okay in explaining the topic. Your most valuable asset is your time. Thank you for sharing yours with me. Until next time.